Hello, so this is hybrid accounts, and we're just going to start with the conceptual framework. You know, you will have conceptual as well as a regulatory framework, but today you're just going to take a look at the conceptual framework. So this is what we'll cover actually. You know, we'll cover the definitions of the conceptual framework, the status and purpose, objectives of general purpose financial reporting. We'll see all that, qualitative characteristics of using financial information, underlying assumptions, elements of financial statements, the recognition, measurement, presentation, and disclosure, as well as concepts of capital and the capital maintenance. So actually, we'll take a look at all these, but for today, let's just try and take a look to see where we'll end. All right, starting with the definition here. What is the conceptual framework? What is the conceptual framework? So as the definition says, it is a statement of generally accepted theoretical principles which forms the frame of reference for financial reporting. Do you see this? Generally accepted theoretical principles. In here, we form theories. They are not actual standards, they're just theories. They could be just references from which a standard can be established, or references from which the way to treat an item that has not that cannot be explained by existing standards can be done, right? So that's what we call the conceptual framework. So the conceptual framework is not a standard, or you can just define it as a coherent system of interrelated objectives and fundamental principles. It prescribes the nature, function, and the limits of financial accounting and financial statements. But don't worry about that. I think this one is pretty clear, this one. All right, so simply speaking, conceptual framework is something general. All right, let's go to the purpose of the conceptual framework. Why the conceptual framework? Now that's why we say that when you have the conceptual framework, it assists the board when developing new IFRS standard. You know which board? And in the regulatory framework, we say that the International Accounting Standards Board, IASB, is responsible for developing new standards and revising existing standards. So when new standards are being developed, actually, the reference can be made to the conceptual framework. That's why I told you it's just a general reference. So that's why we say it helps to ensure that these are based on consistent concepts. You know, the conceptual framework just gives guidance. So whichever standard is developed, actually it has to consider all the facets of the conceptual framework. All right, another purpose could be said as it assists preparers, now let alone those people who are just preparing the IFRS. What about those who are preparing financial statements? You know, if you prepare financial statements, you have to comply with IFRS. So we are just back to those who prepare financial statements. So it assists preparers where no IFRS standard applies to a particular transaction. You need to apply a particular, you need to deal with a particular transaction. You go and look for the IFRS actually that is relevant, but nothing is found. You know, that's why IFRSs are continually developed, because there are some new items that are very significant and they arrive and there is no specific standard to explain them. Or there might be existing standards, but actually as time goes on, as evolution goes on, it happens that those standards which were once seeming to be actually sufficient now would be kind of deficient, and so we need to revise them. So this is the situation, but also we say that it assists all parties when understanding and interpreting IFRS standards. So when studying explanation, this is just a topic of explanation, but we need to understand. So when dealing with this purpose, do not just cram out to know these points. Our main point here is we usually prepare financial statements, so it helps preparers. But when preparing financial statements, we make reference to IFRS, so it assists the board which prepared these standards. But also, we prepare financial statements to give to particular stakeholders, for example, shareholders. So it assists all parties when understanding and interpreting IFRS standards. Simply speaking, it assists stakeholders in understanding and interpreting standards, right? Yeah, so that's the situation, and now we can proceed. You know, this topic here is just about weights, but it's very efficient, it's very important, so we just have to do it. Okay, so now we are at the status of the conceptual framework. By status, we just mean that suppose maybe you have a conceptual framework, and you find out that it is not consistent with the IFRS. Let me ask you one thing. If the conceptual framework says otherwise, and the standard says otherwise, which one would you incline yourself to?
Is a standard.
Very nice. Why? Because the conceptual framework just gives guidance on preparation of standards, but it is not a must for a standard to follow the conceptual framework. Very nice. That's why I will say that the conceptual framework is not an accounting standard, right?
Yes.
Having said this, it does not override the requirement of a particular IFRS standard. Never should that be the case. And we will give a nice example here. You know, when studying the IFRS and IAS, there is something called IAS 12. IAS 12 is about income taxes. When dealing with income taxes, you know, when speaking of these tax authorities of the countries, they usually determine the current tax liability. But we usually say that in the financial statements, you can have, let me give you this common example. Think like depreciation. You know, when you're depreciating an asset, the same asset for the tax regulation body of your country can have that depreciation in a different way. So you might find out that in the first year, you have charged maybe $8 million of depreciation, but that tax authority just needs to charge $6 million. But it's just the way that your accounting policies differ with the way the tax authority of the country applies. And having said this, the tax liability that you would compute in your books would differ to that of the tax authority. So to match those tax effects of the transactions, in the books we usually have to add something called deferred tax. By saying deferred tax, you know, we mean that, maybe you can have the deferred tax asset or deferred tax liability. It could seem that TRI, maybe the tax authority has charged a lot more than what we expected, or has charged a lot less than what we expected. If it has charged a lot less, it means that you have to add something, but this one will be payable at the later date, right? And that's why we call it deferred. But also it could either be a deferred tax asset or deferred tax liability. That's why we say that if you say something is deferred, that means it is related to the future, right?
Yes.
Yeah. But usually when speaking of the asset or liability on the conceptual framework, they say that the asset is a present economic resource, but also the liability is a present obligation. So that goes against the conceptual framework, right?
Yeah.
Yeah. And that's why we say that the deferred tax can be recognized as a liability, although it involves future obligations. The conceptual framework itself says that it is a present obligation. If it's not a present obligation, it's not considered a liability. But the standard includes future obligations in a liability. So that's the particular requirement of the standard cannot be overridden by the conceptual framework. All right, going further, we'll say that to meet the objective of general purpose financial reporting now, the board may specify requirements that depart from aspects of the conceptual framework. The board prepares maybe the standard IS 12, and it says that, for deferred tax asset and deferred tax liability, the conceptual framework will have to forgive us. Will have to forgive us. We cannot follow it, right? That's why these specific requirements are specified that do not comply with the conceptual framework, at which point it will explain the departure in the basis for conclusion of the standard. As I just stated this one. This one is on International Accounting Study number 12, IAS 12. All right, let's proceed. I just want us to get something today, you know, for this guy have a grasp. And then we are here at the objectives of general purpose financial reporting. Now, what is the objective? You know, our financial statements are prepared for different reasons. Someone can say, maybe a tax body, I need your financial statement because I need to know to compute the tax liability that you are liable. But we have the objective of general purpose financial reporting. What is its general purpose? We prepare financial statement, not tailor-made for something, just for general. That's why we say that the objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and the potential. Now, our main goal here, let me highlight the main goal. Right here, existing and the potential investors, lenders, and other creditors, just like this. If we just take a look at that, you would find out that investors are fund providers. Lenders are fund providers as well as other creditors. All of these are fund providers, right? So simply speaking, the main objective actually is very centered on those people who provide funds to the entity, right?
Yeah.
Yeah, so we can just proceed now. This to provide financial information about the reporting entity that is useful to existing and the potential, regardless of whether they are already here or they are just potential, they could be here. In making decisions relating to providing resources to the entity, so they would ask themselves, oh, should I give more? Should I subscribe to more shares? Should I lend more to this entity? Or should I remove my shares? Should I sell my shares? And those decisions that I just stated could be this one, maybe buying, selling, or holding equity or debt instruments. The investors can now decide. Maybe it could be providing or settling loans and other forms of credit. Those are just examples. Now we proceed to say, if investors, lenders, and the creditors, I mean, if those fund providers are going to make these decisions, they require information that will help them to assess what? They would have to assess something. You know, when someone comes, when someone has invested in you, they expect returns, right? So if they have those information, it will help them to assess an entity's potential future cash flows. Whether this entity actually its financial health in the future, the cash flow that it will generate in the future, but also management stewardship of the entity's economic resources. You know, the entity can be able to generate future cash flow, but if management lacks integrity, if management actually cannot perform their fiduciary duties to the shareholders who put them in those positions, it could be very dangerous. The companies could fall. All right. If management is fraudulent, maybe they're just cooking financial statements, they're just doing misappropriation of assets. Maybe they receive money from customers and they leave them as a receivable and they go to the betting shop. Things like that. So we just say to assess the entity future cash flows, how now do they assess this future cash flows? To assess the entity future cash flows, users need information about the following. Maybe you need to know the future cash flow. You have to know the asset that the company has so as to be able to predict somehow the cash flows. Maybe economic resources of the entity, these are assets. Economic claims, these are liabilities, but also changes in economic resources and the claims. Simply speaking, you have to take a look at the statement of profit or loss and other comprehensive income and the statement of financial position. I hope you know these statements, those two statements. Am I right?
I think what you said now, the thing was breaking. Sorry.
Income statement. Do you know the income statement and the statement of financial position?
Yes.
Oh, yes. So this is what I said. To know these future cash flows, you have to be able to understand the income statement, but also the statement of financial position. Those two statements explain all these 3 points here.
Yeah.
All right, now we can proceed here. We say that users of financial information and their needs. Oh, this is just something, it's just something general, you know. It's not that much of a pain, it's just something general. Just like you read or just normal management books or business books. So users of financial statement, we have primary users, and I think these primary users have been explained on the general purpose, on the objective of general purpose financial reporting. Existing potential investors, and then we say here, we can have existing potential lenders and other creditors. I think we explained them already. You can just take a look at why they need information. For example, investors, let's say shareholders, people have invested the shares in your company. We say that information is required to help make decisions about buying shares, selling shares, or taking up rights issue. You know, there is something called rights issue. Do you know about rights issue?
Yes.
Yeah, right, fish. That just usually means that in the company, the existing shareholders are given an opportunity to purchase shares at the price below the market price.
Yeah.
With respect to the respective shareholding, just like that. So that's just an allowance. But also say investors must have information about the level of dividend. They need to know the level of dividend, the past, present, and the future, and then the changes in the share price, because that's what they own. By saying that an investor has a return in the company, they expect dividends, but they hold the shares. They expect capital gain. They expect those shares to rise, and maybe they could sell such shares and have the return. So those are what the investors, those shareholders are most likely to be concentrated on. Sorry, so we just proceed here and say investors will also need to know these are just concepts. It's not about the conceptual framework now. We're just trying to explore the reality of the world. So investors will also need to know whether the management has been running the company efficiently. This is management stewardship. I think you have seen it already up there. So these are just examples, as well as this position, financial position, also the statement of comprehensive income about those income and expenses. So there is not much to explain there. All right, you could also have these potential lenders and other creditors. They say that they need information to help them decide whether to lend to the company. When you go to the bank and you need to take a loan, they just won't give you. Most of them would like to perform due diligence to take a look on whether you will be able to pay them or not, right?
Yes.
Yeah. So say that they will also need to check that the value of any security remains adequate. Let's say you secured the loan by actually putting your assets as a security. Now they would just like to check this asset which was put as a security, is it intact? Or maybe is it sold? Just like that. So these are just examples of what they could need. Then you have other users. These are just other stakeholders, For example, and they're not specified in the conceptual framework. That's why I did not specify them there in the objective of general purpose financial reporting. So it's something general. Employees can just need information. So it's to know about their employment security. Let's say an employee works for you and they know that you are just going to be liquidated soon. Then they would have to seek somewhere. They have to seek another job, right? So that one is also important. Customers are expect you to supply them with goods, so they have to rely on you to supply the goods. So they will need the reliability from you. If they see that your financial statements are very bad, they think that you're just going to be insolvent, you're going to be liquidated, they would have to seek another supplier. Just like that. So these are just examples. You can have the government. The government usually needs information from the companies for tax compliance, maybe for checking for national statistics data, or maybe for just to check if there is environmental conservation or what. Now we are just heading to the points that are very, very useful here. We say that when preparing financial statements, we expect to obtain use in financial information. Let me go up here. Take a look at here. I just said here that objective of general purpose financial reporting is to provide financial information. When someone reads your financial statements, we expect them to get something from that. Now, what features should this financial information incorporate so that it can be useful to those people who are just reading it? And then we come to the new point called qualitative characteristics of useful financial information. What are the qualitative characteristics of the useful financial information? Now, we usually categorize into two these characteristics. We usually say you have fundamental characteristics and we have enhancing characteristics. And the main difference here between fundamental and enhancing is that fundamental characteristics make information to be useful. So even if in case fundamental characteristics are not there, but enhancing are there, they will just be useless, because These enhancing characteristics, as you see them, they just make information more useful. Do you see this? Information just becomes more useful. So if it wasn't useful from the beginning, then it cannot be useful, right? You cannot amplify a zero signal, right? Hello?
Hello?
Yeah, you cannot amplify a zero signal. So now let's just go to the fundamental and these enhancing characteristics. So let's start with fundamental and then we'll go to enhancing characteristics.
Okay.
The fundamental characteristics, we have two of them. We have relevance, but also we have something called faithful representation. Actually, in the last years, in the previous conceptual frameworks, it wasn't, they were saying relevance and then reliability, but now things have changed. So when speaking of relevance, I hope you know the normal meaning of relevance. Now, yes, relevant information will make an impact on the decisions made by users of the financial statement. You know, if something is not relevant, you can just tell someone and they'll just ignore it because they'll just see that, oh, it's relevant to what I consider. I just need to know the financial statements. Maybe you're giving someone things that let's say they are they not have any impact. So let's say maybe you had to state the sales of, instead of saying that you had the sales of 20 billion, you said that you have the sales of 20 billion point 00001. For example, that is something immaterial. Even if you did not state that, you did not state that, no one would come and actually question you, right? Because it's immaterial, it's of no or little importance. So that's why we say that relevance requires management to consider nature and materiality. By nature and materiality, what do we mean? You know, by nature we mean actually the transaction itself. Does it have an impact or not? You know, let me tell you one thing. Suppose in the company, management is not management. Let's say management has got no stewardship. Management actually is not faithful. If management is not faithful, you know, management is responsible for the preparation of financial statements. This nature is very dangerous, and it could make this information very irrelevant because you know, when dealing with if management is not faithful and people expect management to prepare those financial statements, then it's obvious that those financial statements cannot be relied upon. People won't be confident when studying those financial statements. But also materiality. Do you know what materiality is? What is materiality when speaking of materiality? Materiality simply means that something is material if you, in case you omit it or you state it, but in the wrong way, in the wrong figure, in such a way that the users of financial information actually would make very different decisions. That's what we call material. So, for example, when I told you 20 billion and 20.000001 billion, actually that figure, that is 0.000, is irrelevant. I mean, it is immaterial. It has no impact on the decisions of the users. And that's why we say an item is material if its omission or misstatement would influence the economic decisions of users, right? So we can just go and finish up on this relevance concept. The relevance concept should usually give 2 points. It should bear the value. It should bear either the predictive value, confirmatory value, or both of them. That's why we say financial information is capable of making a difference in decision if it gives predictive, confirmatory, or value, or both of them. By predictive, what do we mean? You take a look at the financial, you know, the predictive is just forward looking. You take a look at the financial statement today and you predict what will happen next year, right? Confirmatory. You had your guess maybe last year, and by looking at the financial statement now, you confirm something. Oh, so I was right, so I wasn't right, something like that, right? Yeah. So this is what we speak. And then you have another thing called faithful representation. That when you present the financial statements, you should present them as they should really be. For a nice example here, where you can say that a faithful representation of a transaction would represent its economic substance rather than its legal form. Let me ask one thing. Have you ever heard of something called substance over form?
Yeah.
Yeah. Most transactions, most transactions have the same economic substance as the legal form. Most transactions, you legally own something, and economically you also gain something from that item. Let's say an asset. But this is not usually the case. So simply speaking, of just incorporating the concept of economic substance, of substance over form over here. For example, let's speak of one thing. You know, speaking of these terms, it's very important. When we'll see later that when studying lease, for example, we have something called sell and leaseback. Sell and leaseback. This is explained in IFRS 16. Sell and leaseback. When you have sell and leaseback, you know, you can say that you have sold something, but maybe let me ask you one thing. You have a house, but having a house, maybe you need to lease. Maybe you have a machine. Let's say you need to lease, you do not have money. You need to borrow, but maybe you cannot secure the loan from the bank. So what you do, you act like you sell that machine to someone, but you enter into an agreement that after just selling it, they would lease it back to you. So you sell it, they give you money, but you retain that asset and you continue using it, and you will be paying rentals after each period, let's say. So that's what we call sell and lease back. So we usually determine whether this is a sale or not. It might not be a sale, and this might not be sell and lease back. So it could just be like a normal bank loan. So that's why we say if it's something like this, you should not say that you have sold something entirely, right? You could just say I have maybe I've just asked for the loan, so I have to pay someone just like that. But also, let's say, let me write this example of called consignment. I think of made something like this called consignment inventory or consignment stock. You know, consignment inventory. Like for example, these guys who sell magazines, you know, newspapers. These guys actually normally do not own those newspapers, right? That's why at the end of the day, the unsold newspapers are just taken back and cleared so as new information can be painted there. So consignment inventory, you have inventory in your custody, but actually that inventory does not belong to you. So you just have to check something like that. But also I could give another example. I could say that I could speak of securitized assets, assets under security, and loan transfers. You have given up your asset to obtain the loan. Now, are you supposed to still say that you have that asset or not? Or are you supposed to consider it in a different way? So these are just the points that when there is something like that, actually everything should be made clear. But also now, we say faithful representation would incorporate the following. Faithful representation usually incorporates all of the following. You have something called completeness. If you say you're faithful, that means that all information that is necessary should be incorporated, right?
Yeah.
Yeah. Everything. Neutrality should be neutral. If you say that you are neutral, that means you are not biased. We say there should be no bias in the selection and the presentation or presentation of financial information. Neutrality is supported by the exercise of prudence. You know, there is a concept called prudence. Actually, it was removed from conceptual framework, but actually the new conceptual framework returned it. Prudence. Prudence is simply the exercise of caution. It's explained it very well. Exercise of caution. If you exercise caution, actually, the main goal of prudence here is usually that assets and the income, you know, most people would like to make their financial information seem good. So prudence helps us to avoid that assets and the income are overstated. We prevent that. So it means that assets and income should not be overstated, while Liabilities and expenses should also not be understated. This is the main goal of prudence. In case maybe you have to make a judgment, when preparing financial statements, you won't be 100% sure of everything. So in some cases, you would have to make judgments. So in making judgments, make sure that you are not overstating assets and income, and you are not understating liabilities and expenses when making judgments under conditions of uncertainty, because under uncertainty, you would only have to judge and decide. And so we have another point called free from error. Actually, for information to be faithfully represented, it should be free from error. I think this one is very obvious. No errors or omissions in the description of the phenomena and the process used to produce the reported information. So we have something like it. All right, and then I think this prudence we have explained it already. Just said when preparing financial statements, prepare should exercise prudence. We have spoken of it already. And the prudence I just said that means that assets and income are not overstated, and liabilities and expenses are not understated. All right, just something like that. But it explains very specifically that, however, this does not mean that assets and income should be purposely understated. No, they should not be overstated. So to achieve that, do not understate them and say that, oh, I've achieved the concept of prudence. No, just do it the right way. You just need to do it the right way. Do not overstate just because you have been given the room for judgment. Just like that. So it's just like that. And then we have these enhancing qualitative characteristics. And so we can deal with that here.